Hi everyone, we will go over chapter 2 today. The first part of chapter 2 is to distinguish between merchandising, manufacturer, and service organization. Merchandising organization is a business that purchases finished products and sells them to customers, like retail stores, Walmart, or Macy's. Manufacturing organization is a business that uses parts, components, or raw material to produce finished goods, which are sold either directly to customer or to other manufacturing firm that use them as component part to produce a finished products. Example for this is like car manufacturing company, Ford, Toyota. Service organization is a business that earns revenue by providing intangible products, those that have no physical substance. The organization that provides service, like hotels or tax preparation companies. Let's look at the income statement for merchandising and manufacturing firm and service firm. Let's look at the service firm first. The simplified income statement is simply service revenue minus operating expenses equal to operating profit. The simplified income statement for merchandising and manufacturing firm have two steps. First step is sales revenue minus cost of goods sold equals to gross profit. The second step is gross profit minus operating expenses equal to operating profit. So there's more steps. There's a cost of goods sold and gross profit involved for merchandising and manufacturing firms. Let's look at an example. Plum Crazy, a retailer, had the following account balance at the end of the period. We need to use this information to put together the income statement. So a retailer, remember the income statement for merchandising firms is sales revenue minus cost of goods sold equal to gross profit minus operating expense equal to operating profit. So let's start with sale revenue. So we have sale revenue 150,000. So what's our cost of goods sold? 60,000. So sale revenue 150,000 minus cost of goods sold 60,000. So that's the first part of the income statement. Sale revenue minus cost of goods sold, we get the gross profit. And then the rest, rent, advertising, utilities, salary and wages, supplies and miscellaneous, these are all operating expenses. So we list up all the operating expenses, add them up. We get total operating expenses of 56,700. So a gross profit of 90,000 minus 56,700, we get the net income of $33,300. So that's our income statement for this retailer. So the following information is also available for Plum Crazy. We have beginning inventory of $23,500, ending inventory of $78,500, and purchase for the period is $115,000. So we need to use this information to calculate the cost of goods sold. So cost of goods sold is calculated using beginning inventory, so what you have at the beginning of the period, plus purchases. That's total what you have for the period, right? And then you sell something, we get the ending inventory. So beginning inventory plus purchases minus ending inventory is the cost of goods sold for the period. So the cost of goods sold is calculating using beginning merchandising inventory 23,500 plus total purchase for the period 115,000. We get goods available for sale 138,500 minus ending merchandise inventory. We get cost of goods sold of $60,000. So that's how you calculate cost of goods sold. So let's look at the relationship between cost of goods sold and income statement. We use beginning inventory, purchases, and ending inventory to calculate cost of goods sold, and then this cost of goods sold goes to income statement. We use sales revenue minus cost of goods sold equals to gross profit, then minus all the operating expenses, we get the operating profit. So for manufacturing firms, the cost of goods sold is calculated, it's similar but a little bit different. So we have beginning finished goods inventory plus cost of goods manufactured. That equals to finished goods available for sale. Then that minus ending finished good inventory, we get the cost of goods sold. And then this cost of goods sold will go to the income statement of this manufacturing firm. Sales revenue minus cost of goods sold equals to gross profit minus operating expense equal to operating profit. So let's look at comparison of how to calculate cost of goods sold of manufacturing firm and merchandising firm. So for manufacturing firm, we have beginning inventory plus cost of goods manufactured minus ending inventory. We get the cost of goods sold. For merchandising firm, we start with beginning inventory, same thing, plus cost of goods purchased minus ending inventory. We got the cost of goods sold. So for both firms, we both start with beginning inventory. The difference is for manufacturing firm, they're producing good, so we need to add the cost of goods manufactured. For merchandising firm, then we need to use cost of goods purchased, so that's the only difference. So for manufacturing firm, we're producing goods. So how is the cost of goods manufactured determined? So we have another schedule for material used. So we begin, remember, for manufacturing firms, we use raw material to produce finished goods. So for material use, we have beginning material inventory plus material purchased. That's material available for use. Then minus ending material inventory, we get direct material use in production. So here's the cost of goods sold manufactured. Work in process inventory, that's the beginning inventory, plus current manufacturing cost. So that's direct material, direct labor, and manufacturing overhead. We'll talk about these in detail in later chapters. So that work in progress inventory, beginning work in progress inventory, plus current manufacturing cost, we get total current manufacturing cost. Then we minus work in process, the ending work in process. We get the cost of goods manufactured. So let's look at for manufacturing firms. We start with schedule for material used. Beginning material plus material purchased minus ending material inventory. We get the direct material used in production. So that will go to the schedule of cost of goods manufactured. Beginning work in process plus current manufacturing cost. So this is direct material, direct labor plus manufacturing overhead. The beginning work in process inventory plus current manufacturing cost equals to total current manufacturing cost. Minus ending work in process, we get the cost of goods manufactured. So cost of goods manufactured will go to the schedule of cost of goods sold. We use beginning finished goods inventory plus cost of goods manufactured minus ending finished good, we get the cost of goods sold. Then this cost of goods sold will transfer to income statement. Sale revenue minus cost of goods sold minus operating expenses, we get the operating profit. So this is an example of income statement for manufacturing firms. Sales minus cost of goods sold, we get gross profit, minus operating expenses, we get net income. This is the example of schedule of cost of goods sold. So cost of goods sold go here, income statement, right? Beginning finished goods inventory plus cost of goods manufactured, we get goods available for sale, minus ending finished goods inventory, we get cost of goods sold. This is a schedule of cost of goods manufactured. Beginning working process inventory plus current manufacturing cost. Current manufacturing cost is calculated using direct material plus direct labor plus manufacturing overhead. So that's 63,000. Beginning balance of work in process inventory plus current manufacturing cost, we get the total cost of work in process minus ending balance of work in process, we get the cost of goods manufactured. So how do we calculate direct material use in production? Here we have beginning balance of material inventory plus net material purchase, we get material available for sale. Material available for use, minus ending balance of materials inventory, we get direct material use in production. So let's look at service organization. We have this law firm. We have the following information. We need to use this to put together an income statement for this law firm. So we need to, for income statement, we need to start with service revenue, $1.5 million, minus all the operating expenses, office rent, office utility, salaries, attorney salaries, paralegal salaries, office expenses. These are all operating expenses. So we use service revenue minus all the operating expenses, we get the net income. So this is how the income statement for this law firm looks like. Service revenue, $1.5 million, minus all these operating expenses, administrative salary, attorney salary, office expense, office rent, paralegal salary, and office utility expense. So our total operating expense is $1,044,500. Our service revenue minus total operating expense, we get the net income of $455,500. Let's look at an exercise. Module company manufacture kitchen equipment used in hospitals. They distribute their products directly to the customer end. For the year ending 2019, they reported that these revenues and expenses. So we have sale revenue, cost of goods sold, and operating expenses. We need to use this information to put together income statement for 2019. So we have sale revenue of $985,000 minus cost of goods sold $489,000. We get the gross profit of $496,000 minus operating expenses of $245,000. We get operating income of $251,000. So that's the income statement for module company. Let's look at the next exercise. We have a retail business. It sells variety of beach apparel, t-shirts, beach-related souvenir items. They purchase all of their inventory from wholesalers and distributors. For the year ending December 31st, 2017, they reported these revenue and expenses. We have sales and expenses. We need to use this information to prepare the income statement for 2017. So our income statement, this is just beachy for year 2017. So we have sale revenue of 685,000 minus cost of goods sold. We have here 315,000. We get the gross profit of 370,000, and then we have operating expenses, advertising, building rent, sales staff salaries, supplies, utilities. So all of these are operating expenses. We add all of these up, our total operating expenses 215,000. So our gross profit of 370,000 minus operating expenses of 215,000, we get net income of 155,000. So that's the first part of chapter 2.